Today I'm going to show you this trading strategy that will be by far the most simplistic and straightforward trading strategy that you have ever heard of. It's the kind of strategy that can make you anywhere from $100 to $500 to even $1,000 per day every single day that the stock market is open. In fact, it's so effective it requires zero indicators of any kind, no need to draw lines or any other type of chart voodoo. All you need is a tiny bit of patience and a set of eyes, and your eyes don't even need to work that well. Also, this is the type of strategy that checks all the boxes of a long-term winning trade strategy. It's the type of strategy that's almost impossible for anyone to mess up. It's the kind of strategy where the risk to reward ratio is off the hook. And it's the type of strategy that is scalable, that happens every single day, and you can continue to scale up and add more position size as you get better. And that strategy is something that I learned 15 years ago. That's called the check mark. And today what I'm going to do is show you how this particular check mark trading strategy will completely revolutionize your trading world. So I'm sure by now that everybody knows what a check mark looks like, right? This is like first grade stuff. But I'm going to draw one out because what I want to do right now is just get your eyes and your mind trained to start looking for this rhythm. And something I didn't mention at the beginning that I should now is this thing is universal because it's a nuanced kind of trading system that will work with anything. Foreign currencies, cryptocurrencies, stocks, index futures, doesn't matter what you're trading, and it doesn't matter what time frame you use. You can use 1 minute, 5 minute, hour, daily, weekly, monthly. None of that matters. It can be used for anything that you want because it's repetitive. Now, what we want to focus on are 3 steps to this pattern. The first is we're looking for some type of sell-off or successive red bars moving in one direction. Something that appears to be a sell-off, but it's not. It's actually a trap. But it's going to look like this is going to sell off. It could be a rapid sell-off. It could be a mild sell-off. That doesn't matter. We're just looking for consecutive red candles moving downward. That's step number 1. Now, at some point, this is going to come to an end, and I'll talk about that here in just a second. And that's what we're going to use as our execution area. And then the very last is the tail end of the check mark, and this is going to be our expectation or our profit. So you probably can already see that the check mark takes care of a few things. First, because we're looking for this consecutive move, and it's somewhat of a reversal strategy, it's not something that sneaks up on you like a breakout. You're going to have plenty of time ahead to rehearse this trade and to think the whole thing through. So as I said in the beginning, very difficult to miss this trade. The second is you're going to be entering on the very low pivot next to what we're going to call a well-sized buyer, which I'll show you here in just a second, which is going to keep your risk extremely low for this trade. And as all traders, when we start out, we struggle sometimes with our exit. This is going to set the expectation on what kind of money we can make on this trade. But for right now, just take a close look at this check mark, kind of get this embedded into the brain there nice and deep. And I want you to take a look right now at the chart I have on the screen, which is the last few days of NVIDIA's trading. Now, if you're new to this Thinkorswim charts, just so we're all on the same page, I want you to kind of take a look at the upper area. The gray areas right here are pre-market trading, and the black areas are regular trading hours. I just want you to focus on the black areas for right now, and then we'll go to the grayer areas in just a second. But I want you to just see how many check marks that you can find in this chart. I mean, we see it went from $104 to low up to $118 in a period of days, but look at the route that it took. And just real quickly, you can see there's like a check mark here. There's one here the next day, the 3rd day, the 4th day, the 5th day, and even the 6th day. So 6 straight days, there's been some form of check mark pattern. Now, take a deeper look at this and how these check marks are being developed, because this is where the nuance comes in. So let's start back here on this day. You'll notice that NVIDIA takes off right out of the gate. Looks like it's going to be a breakout, just sucking in the longs, right? It's like, oh, this is going to rip. Everybody's got to get in. They're all FOMOing. They're diving in. They're just hitting market orders. Next thing you know, it sells off. Now, at this point, everybody's thinking, oh man, this is a mistake. This thing is going to go down. It's going to go down. It's going to crash. The world is coming to an end, only to hit a pivot point, rally right back up to the high. But notice, early morning impulse, followed by an aggressive sell, followed by an aggressive bounce. The next day, same thing. Very impulsive, very strong. Looks like it's going to break out. Sells completely off, right? Looks like it's doom and gloom. Wait a minute. Not. Comes almost back up to the very high of day. The third day, same thing. 3 days in a row, guys. 3 days in a row. Impulsive move at the open. Sell off followed by a monstrous full extended check mark. Day 4. Instead, on this day of getting it at the open, you actually dive right at the beginning and then you bounce, right? But you'll see every single day, right towards the open, there's that move. You're either impulsing up and selling off, or you're beginning the day with that sell-off. Now, let me just stop right there for a second. What can you do with just that information? Without even going any further about the check mark, just looking at that brief nuance, could that not help you with trade structuring? I mean, wouldn't what I just said here, looking at the charts, tell you that you should not buy any impulse at the open? That you should not short any sell-off? I mean, just right there will tell you what you should and you shouldn't do. So if you don't take anything away and you can't listen to me talk for much longer and you're like, I gotta get the hell off of this line, this guy's driving me crazy, I'm gonna exit out this video, at least take that with you. There's a trade to be had, and we're gonna go over that here for just a second. But take a look. Every single day, this pattern is basically served up to you on a silver platter. Now, I know a lot of people are gonna say this right now. How do you know? How do you know that that sell-off isn't the beginning of a market crash? That it's not going to manifest in some nasty, gnarly, destructive sell-off? And that's a good point. And for that, we're going to use two major components to really enhance this strategy. And those are, number one is levels. I'm going to try to write this with a mouse, and I apologize if it doesn't come out very nice. Let's just put level. How about that? And number two is something I call a measured move. I'm going to put double M, like M&M, but it's the measured move. So first, let's talk about the measured move. If you look at the very base of this, we're roughly at, say, $104, and it immediately impulses and gets vertical and stops roughly, let's say, around 108. Right? We don't have to be perfect all the time with the technicals. We're just trying to get ourselves isolated in a zone and pick the right side to trade. So that move itself is roughly $4. The subsequent move that comes after that, the sell-off, is also about $4. If you take a look at this move, it impulses up from roughly 106 to about 110, which is also $4. And it proceeds to sell off roughly $4. You probably at this point know exactly where I'm going with this. This is probably another $4 roughly, and another $4 down. So the measured move in this thing is anywhere from $3 to $4. And that means that if you're seeing a move in succession that's more than $3, there's probably an 80 to 90% chance that that move is going to come to an end. You see, everything that you trade has what we call a measured move. And that's sort of like the instrument's stamina. Like if you're to take off and you start running, how far can you run before you get tired? That's your measured move. That's what you are worth. That's the expected value. And with that, you can make better trading decisions. So again, going back to what I said just a few minutes ago, if you shoot up $3 or $4 in the morning, that's not a buy right there. That's probably going to get reversed because it's part of the measured move. Now let's take a look at the second part, or what I put down was the first, is the levels. I want you to take a really close look on the chart where each one of these bounced, right? So you start up here. I want to just draw a line right there. You move down, but take a look at where this stops. It revisits a previous area, a previous pivot area, also known as support. I guess the newer generation likes to call it liquidity. But there's a zone down there that it revisits where this buyer shows back up. Now you come back to the next day and you'll see that the downdraft is roughly $3 to $4, stops right here. Is this a magical, random, just something out of the blue? No, it's actually right back to a previous day's pivot. Let's say an area of liquidity, an area of support, an area of pivot. You don't even need to use those fancy words. You just need to know there's some buyer. So let me focus on that for just a second. In that area represents a past buyer, a buyer that we're looking for to show us commitment. Will that buyer reemerge back into that spot? You take a look at this area. Is this area random? Is this something that just come out of nowhere? No, it's right back in to that support structure. And it keeps repeating that. So every day, this thing is taking a run at a down level. It's selling off and revisiting past levels. Now, is this something that I could tell you for sure why that's happening? No. Is it market manipulation? Is it algorithms? Is it shenanigans? I don't know, man. But you know what? I don't care, because I know that every single day, that somewhere after every run up or every sell-off, something, someone of a much larger size than just you and I is going to emerge and save the day. And it always comes after a move, gets you thinking bearish, 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 bullish, 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 and it pulls back on you every single day. And we'll talk about that again in a second. But you'll notice this thing is moving in one direction and tags a level. So from that, if NVIDIA moves $3 down, the first thing you should be doing is looking for where will this stop. And the ideal thing is to start looking left. For every technical analysis you have, start looking left in your chart. Start digging out, where might this thing end up? Because somewhere between $3, $4, or $5, someone's going to show up and they're going to save the day. Now, for all your newer traders, the magic in this is when you're putting a stop loss somewhere, sometimes you're not confident of that stop loss. You don't know if it's going to hold. But when this buyer starts to show up and you realize this is a serious, large institutional whale, whatever you want to call it, monster of the market, doesn't matter. That's like your imaginary backing. That's somebody there of a larger force with larger money than you and I could ever imagine. And that's your stop loss. You want to try to get next to that person as often as possible. So the way this is traded is, as it moves down there, you are looking for a specific series of candles to develop around that area. So I'm going to open this up a little bit more and let's take a look. So as this moves down, I want you to take a look, and in your spare time, always do this kind of study. Start looking left. You'll get your secrets. But take a look at what happens here real quick. As you get into this area, a wick emerges. One of my favorite types of trading signals, because a wick constitutes an abrupt change of sentiment. At one time, it looked like this candle was robust, full-bodied, looks like, death is soon, and all of a sudden, just like that, comes right back up. And you'll see, 5-minute chart, tested it again, tested it again, tested it again. Now, the more times this thing tests it, it's apparent somebody's there. Again, call it what you want. Call it liquidity, call it support. It doesn't matter. All that matters is that you start to become aware and acute to the section that, look, somebody is here. Somebody wants this thing. Somebody bigger than me. And the end result is you get a really, really nice check mark. Now, the thing about the tail end of the check mark is this is trading. We never really know what our target's going to be. Sometimes these targets are just going back to the high of day. That's usually what they are worth. Other times they'll be very magical and they'll extend. I mean, that's trading in general. So there's one of them right there. Look for those little wicks. Now come over here again. What do you have here? Another wick. You have 1, 2, 3 tests again of this area. So when you see this area and you're aware of that area, the closer you get, start looking for wicks, start looking for engulfing candles, start looking for something to come in like this. Look, just something to show you that something is there, right? Let's move it over here. Again, what do you see here? 2 wicks on this one, right? Right there. And then right there. This one was off to the races right here. And let's just keep on going. And you'll see every day, if you look really close, there's a sign. Here it is right at the open. Huge tail wick. A huge wick. See that? Right into the premium level. Right? Huge wick into the premium level and so on. So every single day, you are getting that repetitive move. So let's go back here for just a second. Some of you may have thought, is there another way? I'll give you a bonus. Let's say that. This is just not a long biased strategy. I'm sure some of you thought, could I use that to actually short the $4 move? Is there a thing called a reverse check mark? Yes, there is. So could you have shorted the $4 impulse and then tried to cover that short into the buyer? Yeah. And if you thought of that, you're on the right track. But see, here's what we're looking at and why this is so powerful. It's not about indicators, because indicators are lagging. What people need to understand about technicals, it's very simple. We just love to complicate it. It's a matter of where is the biggest buyer and the biggest seller located on this chart. The biggest buyer is always down at support or liquidity, whatever you want to call it. That is the whale buyer. That becomes the whale seller. And you're working in between those levels for entries. Now back to the check mark. As we're moving there, in a recap, we want to see that buyer, that seller. Will that check mark develop? Will we see wicks, engulfing candles, consolidation, anything to show us that this thing is going to slow down? Now, the other beauty about this is, look, nothing is perfect, right? We know that. Nothing in the world is perfect. And you're going to lose. But the beauty of this strategy is that if you lose, your stop is just slightly underneath of that big buyer. Because if the big buyer doesn't show up and save it, or they fatigue out, well, then it's going to go a lot lower. Then maybe you want to short it. That's another strategy completely. But it'll at least tell you if this thing is going to work. It won't be the kind of trade that go, oh, geez, I got faked out. And your risk is so low that you don't even have to win them all the time. Like, you just need a couple of these big moves every week to take care of you, and you're good. It's simple as that. You don't have to overcomplicate it. So let's leave it right there for today. If you like what you've heard or you want a little bit more, just comment down there in the comment section. I'll try my best to get back to everybody. But let's focus on this. Every day, take a look at whatever you're trading. Start with a measured move. How many pips, dollars, or points does it move in one direction? And in that direction, will I ever match up with a very large seller, a very large buyer, right? And when I get to that area, or as I get close to that area, start looking for the signals, those signals of engulfing candles, wicks, consolidation, just something to show you structure, that something is there. Place that trade, put that stop there nice and tight, and look for it to expand. Some days it will expand and you'll make a lot of money. Other days it'll just be a cash flow trade, but it's a great way for you to get on the right side of the trade. So guys, I want to say thank you for watching this video today. I really appreciate it. Make sure you like and subscribe it if you do. If you don't, that's fine. I hope I'm able to shed some light on this. Hope this is a strategy that you find that's viable and that you can use in your business. Until next time, thanks for watching. Cheers.